Ladies and gentlemen, good day and welcome to the Q1 FY24 earnings conference call of NMDC, hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Amit Dixit from ICICI Securities. Thank you, and over to you, Mr. Dixit.
Yeah, thanks, Michelle, and good morning, everyone. On behalf of ICICI Securities, I welcome all of you for NMDC's Q1 FY24 earnings call. At the outset, I would like to thank the management for giving us an opportunity to host this call. We will begin this call with brief opening remarks from the management, post which we will open for an interactive Q&A. Thanks, and over to you, sir.
Good morning, everybody. So can I speak now?
Yes, sir.
Yes,
please
sir.
proceed.
Good morning, everybody. So thank you for connecting, and this has been the best quarter ever, Q1 ever since inception for NMDC. And not only Q1, it has been the best Q1, Q2, Q3. So if you leave aside the Q4, which is of course always the star quarter, if you leave out that quarter, so this has been the best ever quarter, except in Q4. The good thing is that April, May and June, they individually have also been the best, both in terms of production and sales since inception. So that's a remarkable achievement that we've been able to log, and this absolutely dovetails with our annual plan of anything between 47 to 49 and God willing even up to 50. So to that extent, as per the annual plan, we are on the right track. The most heartening aspect is that this time our sales has been, up till at least July, about 1 million ton extra, 1 million ton over our production. So that's really heartening. That gives us great leverage. And also as the production goes up, our cost of production per ton comes down. And despite the margin pressures that we have, as you know, that we have taken a slight price adjustment a couple of days back. So despite those small hiccups in prices, because of the increase in volume and the consequential reduction in prices per ton, cost per ton, I am confident that we will be able to maintain our overall EBITDA margin of 40-41% on an annual basis. So overall, I think what has been good, and what we are looking at is also very encouraging. So I think we can now sort of have a firm footing where we can make this quantum leap to 100 million ton in the next 5 to 6 years, for which our plans are right now. Some of them are already being executed, and some of them are at drawing board stage, and we hope that we'll be able to do that by 2030. We already have a new NMDC logo for NMDC 2.0. It speaks about our commitment, it speaks about our aspirations, it speaks about our pride past. So going forward, we are very hopeful and very, very optimistic of the future. So thank you. We can have the questions now.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on the touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask questions. The first question is from the line of Alok Deora from Motilal Oswal. Please go ahead.
Good morning, sir, and congratulations on picking decent numbers.
Sorry, your voice is cracking. Your voice is cracking.
Yeah, good morning, sir. Can you hear now?
No, it's very, very disturbed. Something needs to be done about the line.
Hello?
Mr. Deora, please proceed with your question.
Yeah. Sir, just wanted to understand this price now which we give including royalty, DMF and MET. So if you just want to calculate it as against the previous price you used to give excluding that, then what would be the typical differential between that? So just you could indicate how much is the difference now for these three items.
Am I audible?
Yeah, please.
Yeah. You see, the normal loading is around 21% because of the royalty and royalty issue. But that's not the only thing. We have, while going for an integrated pricing internally, we have seen the correlation that is there because between our prices and the IBM prices is generally 0.996 in Chhattisgarh and 0.992 in Karnataka. So we've had a regression analysis and we've checked out. So we've had a factor of neutralizing that as well. So it will not be a straight to straight. The last time we declared in July, so it's not a straight sort of 21% loading. So it was an internal mechanism that we where we hedged our risk for the first time against the IBM prices that could be fluctuating. So after hedging, then we declared up prices. So if you ask for a straight correlation, I don't think it will be arrived at, but it will be around 21%, 22%, around that percentage. And going forward, after 3 months, when things settle down, I think that would come to around 21.4%. But you cannot have a one-to-one correlation.
Sure. And sir, any update on this NMDC steel plant? Any update on that?
Yeah. We have commissioned the blast furnace.
Yeah, 2 days. I think few days back only.
And on 12th we lighted it. Now hot metal is coming out, and I think in another 2 to 3 days, hopefully the silica will come down to less than 1%, and then we can take it to the SMS and then roll it. So I'm looking at somewhere around anything between 21st to 23rd. In fact 20th to 23rd, where this plant will be fully commissioned. Because we have already produced 3,000 tons per day right now output. The output will go up and the silica will slightly come down. We have already started the pig casting machine, so it's taking that. So touchwood things are online after the commissioning of the blast furnace. Another 7 days, I think we should be done and dusted.
Yeah, sure. I was asking actually from the time any this disinvestment, any update on that?
That procedure is being run by DIPAM. So as you know that the UI had been called for, and this is a state-of-the-art plant, so obviously there is a lot of interest. Exact numbers I cannot say you whether it is 5 or 8 people have applied, but I'm told that a lot of we are not privy to the names who have sort of participated, but there has been more than adequate interest in that. So which is very obvious because it's a state-of-the-art plant and absolutely the modern plant. So naturally there has been more than adequate interest. Now that the commissioning will be done, I understand that the pace will pick up. Because a lot of things where people were looking at the commissioning to happen first.
Sure.
Now that's done, I think the space will pick up. But it's not being run by us, it's being run by DIPAM. That we have to understand.
Got it. Just last question. So just some status update on the CAPEX plans which we have been undertaking. What's the status on that? Is it progressing as per the plan, or Any changes?
As you know that we did, including Nagarnar last year, around 3,600 crores. This year, excluding Nagarnar, I think, although we are targeting at around 1,700 crores, but I think we should be doing around 2,000 crores. Well, now we have got major project sanctioned. So going forward, I think the normal would be at around, if I am to go to 100 million ton in the next 5 to 6 years, then the total investment per year has to be more than 5,000, 6,000 crores. I think somewhere rather in the vicinity of, when we get all our projects sanctioned, somewhere in the vicinity of 7,000 to 8,000 crores going forward, 3 years from now, once we get all the projects sanctioned. Our existing projects for the next 2 years should be, I think, more than 2,500 for the next 2 3 years.
Sure, sure. That's all from my side. Thank you and all the best, sir.
Thank you.
Thank you. We'll take the next question from the line of Mohammed Farooq from Pearl Investments. Please go ahead. Mr. Farooq, I have unmuted your line. Kindly proceed with your question. As the current participant is not answering, we'll move on to the next question, which is from the line of Pallav Agarwal from Antique Stock Broking Limited. Please go ahead.
Yeah, good morning, sir. So just wanted
Morning.
yes, so just want to know on any updates on the coal blocks on, so when are we planning to commission, what production targets are there?
As you know that there are two that we have. One is Tokisud, the other is Rohne. So Tokisud, we are in the land acquisition phase. Of course, now we are going for both these coal blocks under the Coal Bearing Area Act, which is the CBA Act, which is we have applied to the Ministry of Coal for the relevant notifications. And that would expedite, hopefully, as you know, in Tokisud, we have already appointed an MDO. So once the clearances are there, it should take about a year end, somewhere around early next financial year or in the closing stages of this financial year, we hope to do some mining in Tokisud. Rohana is, of course, more than a year away. The approvals have been just sought for, and Rohana would take us somewhere around FY25, made somewhere around that. But that's the bigger block. And the main thing is now that we need the notifications under the CBA, Coal Bearing Area Act, CBA Act.
Sure, sir. So also, sir, any update on the SPV amount that, 50% balance that we were to receive? So is it possible to receive that in this FY24?
That will depend. We have petitioned the topmost court, so we are waiting for a decision. We are confident that it will come in our favor, but of course we cannot set a timeline. I hope that we'll get it this financial year. I hope that we will. I can't say for certain, but yes.
And so currently on whatever we are selling in Karnataka, are we paying that 20%, or we are paying only 10% right now?
It's only 10% now. We won that case. No? We won that case,
so
it's only 10% now. They refunded us around 1,990 odd crores, and we are so
okay.
It's only 10% now.
Okay. So lastly, sir, I think we had this. We got this clearance to expand the mining capacity at at Karnataka. So will we see some incremental volume? Yes, sir. So will we see some incremental volume?
We hope to operationalize that. You see, we've got the EC environmental clearance. We have got it for 10 million ton. Now, one more clearance from the monitoring committee is required because Karnataka itself is fully capped. So that cap needs to be readjusted, and from that 35 million ton or 40 million ton cap of that area, that has to be redistributed. Only that is left. So hopefully, if we get it soon, our target to operationalize that is around 1st of October, the additional. And if that comes through, I think we should be getting at least 3 out of the 2 extra million tons, 2 out of the 3. And that is why the current guidance, as I said in my opening remark, is around 47 to 49. and hopefully 50. It all depends on how soon we can operationalize these things.
Yeah, right, sir. Thank you so much, sir.
Thank you. We'll take the next question from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Yeah, good morning, sir, and thank you for the opportunity. First question is, sir, your comment on CapEx, it's not very clear to me. So this year you're saying 2,000 crores is roughly the ballpark we're looking at, and based on existing projects which are already approved, per year 2,000 crores is a number to kind of work with for future years also.
Next year, I think we should be doing much more than that. I think 2,500 would be minimum next year, if not more. We are trying to literally drive the capex because we believe that going to a 300 million ton, not only the existing projects needs to be completed fast, but a lot more needs to be sanctioned. So capex is something that we will really have to look at. And this year, I think we'll do 2,000. Although our budgeted target is around 1,600 only, the official number is 1,600.
And what is the 1Q capex, sir?
Beg your pardon?
Sir, how much did you spend in 1Q?
Q1, I think we've already spent, just a minute, capex till date is already, we have touched around 606 crores for NMDC up to August. Q1 figure, I'll have to actually go back and see how much capex I've done. But up to August, 600 crores we've already reached, and I remember around 40% of the capex comes in the Q4 only. So we are in line to do around that number. Q1, of course, I'll have to revert back.
Got it.
Just a second, I can. It was 351 in Q1, but by now we have reached 606 by end of August. By actual of 15th of August.
Understood. So second, on the volume growth, so if you see 2018 to 23, we've been quite range bound, 36, 38 million tons. So one is when we are kind of expecting around 10 million ton addition this year. Just want to understand what would be the breakup. Are we also, how much are we expecting to supply to Nagarnar? And if you could share what is the estimated breakup of this 10 million ton from Karnataka and Chhattisgarh?
The Karnataka, as I was telling in the previous question, we have got the EC for additional 3 million ton. So this year, if we do it in October, if we operationalize in October, maybe 1 point of more than 2 million ton should additionally come. From the production side, we also have a 2 million ton capacity upgradation project in Bacheli in Chhattisgarh. So that's going to be another 2 million ton there. That's going to be commissioned in September end, definitely October. So we are going to get 1.5 million ton from there also. And then we are hopefully by January we will be starting 365 days working. Right now we have weekly offs. So we are getting additional equipment and manpower to ensure that we have 365 days working. So that should be giving us quite a volume there. And a couple of mines in Chhattisgarh which are doing 2 shifts, 11B and 14C. We are planning the 3rd shift there, but we are infusing material and men, and we'll do the 3rd shift out there as well. So taking all this, I think it depends on how early we can operationalize all these 4. So that is why we're keeping a guidance from 47 to 49, or maybe hopefully if things are 50 this year, and next year it will be more than 50.
Okay. So for this additional 3 million ton and 2 million ton upgradation in Chhattisgarh and 3 million ton capacity in Karnataka, do we have both the screening plants, plant equipment in place for additional capacity, and is evacuation not a constraint?
Yeah, we have the plants.
And evacuation is also...
In fact, Bacheli, it is the screening plant upgradation that we are talking about. So we have the mining capacity, but we had a limited screening capacity. So that's a debottlenecking which should give us 2 million tons.
Okay. And so when you say about increasing one shift and working 365 days, was it new this year or was it also happening in the Jan-March period in the FY23?
No, it was not happening. In fact, it will not happen immediately also. The earliest we can target this is January. Okay. Because I need men and material for that. No?
Yeah.
Men and equipment for that. So sourcing, they are not available off the shelf. So we have ordered the equipment. Once they get delivered, by the time we'll recruit the people also. But we have set ourselves a target of January. If we can do it earlier, we'll be gaining. If we do it later, we'll lose. So, but internally, these things are. Chhattisgarh was operating 6 days a week, and 1 day was of maintenance. We are changing that.
Okay, and sir, how much are we supplying to Nagarnar? What is the estimate for this year and say next year?
Nagarnar would consume at the peak around 4.5, 5 million tons.
And this is entirely from our existing mines, right?
Yeah, all from mines.
Okay, got it. And just one last question, sir. So the news reports that we are eyeing partners to tap lithium mining in Australia and also some early exploration work in India. If you can just share what exactly is happening in Australia, what is our interest stake there?
So Australia, we have a legacy, and we are going to do the gold mining in about a month's time. A month and a half, we'll start our own gold mine there. All the approvals are there except for one, which is expected by this month end. Once we get that, we'll take about a month to tie up the further logistics and start mining around end of September. For sure, that will be our own gold mine, and we can use the proceeds to go into further exploration. Regarding the other things, that we have a very big tenement there, around 17,400 hectares, where we have which was jointly owned by NMDC and Hancock. So now we have a third partner, which is the Atlas. Atlas, as you know, is the fifth biggest mining company in the world, and so we've tied up with them for the magnetite exploration, which is at the almost the final stages of the PFS, preliminary feasibility study. The initial results are very encouraging. So if that fructifies, it can go up to a 15 million ton magnetite iron ore mine in the next 5 to 6 years. And also that tenement has some potential for lithium and other minerals. So again, the tie-up is with Hancock, so that we can explore those minerals also in that tenement.
Okay. So Legacy has been a loss-making entity since years. So what sort of profitability are we expecting with this gold mining start? Is there any visibility on your earnings metrics as well?
Initially, we don't expect it to have bumper profits. The first mine that we are doing is essentially not a very big mine. But whatever we earn from there, I think we expect to earn around $15 to $20 million. What we expect to do with that is to plow that back to the another 4 to 5 adjoining tenements that we have for gold, which is very promising, and see the results there. If the results are encouraging, then we can go in for a big time gold mining, and that would be at scale. This is more of sort of experimental in the thing that we have not mined in Australia. We want some first-hand experience. We are not looking at the money part right now. We are looking at enough so that we can plow it back to invest in other gold tenements that we have, and also to gain experience. So the next phase would be the one that will be the one in scale. This is smaller one.
Got it. Okay, thank you so much, sir, and all the best.
Thank you. We'll take the next question from the line of Ruchika Dhanuka from Phillip Capital. Please go ahead.
Hello.
Yes.
Yes, please.
Hi, this is Vikas Singh from Phillip Capital. Hi. Sir, I wanted to understand our realizations. If I look at our realization, which has gone up on a sequential basis, but we have started getting a price cut from the June itself. So just wanted to understand the.
Sorry, I didn't understand your question.
Hello.
Sir, I would request you to increase your volume a little bit.
Is it better?
Yes, yes.
That's better.
So just wanted to understand our realizations, which has increased on a sequential basis, but we, on a monthly basis, we have started to cut down prices from the April onwards. So just wanted to understand how much of lag we are expecting, or is there any mix change which would have resulted in a better than expected realizations?
The mix change yielding to better realization. I think we are some time far from that right now. We need the infrastructure to do the blending, etc., etc. Yes, I believe you're talking about iron ore prices. They have. I believe you're talking about iron ore prices, right?
Yes, sir.
So yes, so that there has been severe pressures on the prices, as you know, since the this entire financial year. We've not been able to take any price increase. In fact, we have had to sort of reduce it quite a few times, including the one a couple of days back where we had to make a marginal adjustment. But I hope we have bottomed up and the prices would go up. The good thing about thing is that since the volumes have gone up, and this is a fixed cost industry, so your cost per ton has come down. So that really compensates for the loss of pricing leverage. So to that extent, yes, the margins we will be able to sustain. But hopefully, let's see what happens after the monsoon, so the steel demand picks up, and as of now, there's no visibility of something great happening on the price front. So I think we'll just have to survive this pricing pressure as of now, and that's what we are doing.
Sir, actually, I was just referring to our to 1Q price increase over 4Q levels, while our average realization was on a continuous declining trend since April. So just wanted to understand the reason for that particular.
Q1 prices, I'll just it was just marginal. We had taken one. I think around March we had taken some price increase at that point of time. So thereafter it has been completely down south, because the Q4 prices were around 4,663 and Q1 prices average domestic realization was 4,850. It was only a marginal increase of 4%. We tried to sustain that in April, and then thereafter we could not, because of the market dynamics. So even after Q4, it has not been very encouraging to us.
I'll take that one, sir. Sir, my second question pertains to our evacuation plans of railway doubling as well as the study pipeline. If you could update us the stage of completion they are right now.
Yeah, out of the 50 kilometers of railway line upgradation, I think more than 100 kilometers has already been done, commissioned, and trains are running there. The last stretch, which is around 25-30 kilometer stretch, is being under construction. We are told that phase-wise, by the end of this financial year, they will be able to deliver. But the problem is not of line capacity as of now. The problem is the availability of wagons. The even before the doubling, the capacity was 28 million ton, and now the capacity is around 40 million ton. So it's not a capacity constraint; it is the non-availability of wagons that is the problem. Because we are producing around 30 million ton from Bailadila, approximately 8 million ton, 7 to 8 million ton goes through the conveyor of ArcelorMittal. 2 million tons goes through road. So we are able to, our requirement is, our rail transportation is only 20 million ton. But if the rakes are available, then we can really upscale our dispatches through rail. So it's not a capacity constraint issue in terms of line capacity. It's more of availability of trains and rakes. That is the issue. The railway has been helping us a lot. Q4 we did an average of 18-19 rakes, which we need to do annually, rather than the 14 or 13-14 rakes that we get now.
Understood, sir. Sir, in terms of NMDC steel, what are our FY24 and 25 production targets?
This year we'll have almost the entire H2 to us. So for production, so we should be touching about 1 million ton in the H2. We have a constraint of non-availability of lime and dolo because the plant has not yet come up really. And despite we using purchased lime and dolo for making steel, we should be able to do about 1 million ton this year, and more than the plant would be full capacity next year. Because these are modern plants, you really don't need too much of a problem in ramping up the production once the availability of inputs are there.
Understood, sir. So just last question, what is our net cash balance as on 1Q end?
Net cash balance of some 7,000. At the end of Q1, I think it was around 7,800 or not. I'll just have to refer to that particular figure. Yeah, I think it would be there in the presentation. Just give me how much? What was the Q1 total? Q1 we had net cash balance of 11,279 crores.
11,200. Yeah, that's all from my side, sir. Thank you and all the best for future.
Thank you. We'll take the next question from the line of Kamlesh Bagmar from Lotus Asset Managers. Please go ahead.
Yeah, thanks for the opportunity, sir. So with regard to this legacy operations or legacy mines, it has been in our belt for last 10-12 years, and we haven't been even able to extract iron ore from there. And even for this lithium mining.
What? Iron ore?
Yeah. I'm talking about the Australian operations or Australian subsidiary. So around 10-12 years, and we haven't been able to mine even the iron ore there. And apart from that, for this lithium as well, we would be left with around for 20 or 9% stake after say this arrangement which have been done with Hancock. So what potential could be there in terms of earnings, because we would be hardly left with now around 29% stake, which we used to had around 80% earlier prior to this deal. So if this entire prospecting and all those activities go on, so how many years would it take, say 5-7 years, and after that what commercial arrangements would be there? Would it be around all trading operations? How that would proceed if the feasibility studies are in positive format?
Right. Number one, first you must understand the Legacy is essentially an exploration company. It is a junior mining company. So its main business was exploration. And naturally, as you know, mining, all explorations do not lead to success. So the success rate is rather low, especially most of its exploration was in terms of deep-seated minerals, where the success rate is as good as going to a casino and winning a jackpot. It's not quite different. So to have expectation of mining from a junior mining company straight away, or a definitive mining plan, I think that expectation is something wrong, because that's not the way the Legacy was working. The good that we are able to, we were successful in one of the tenements to get gold, and we just got lucky there. And we have a few more tenements which are promising so far as gold is concerned. Now, so far as the big tenement of Mount Bevan is concerned, where we have entered into a agreement with Hancock, you must realize that Legacy did not own 100% of that. Legacy used to own 60% of that, and 40% was owned by another company called Hawthorne, which were the original owners of that. So we were only owning 60% of that. Now we are actually getting down to 30% of that. And it's a sweetheart deal in the sense that we have zero risk. So we are not spending, the PFS is costing around more than 200 million, right? And we are not spending a dime on that. In fact, we got around $10 million to sign that agreement. So we are not spending a dime on that. And if we get 30%. Of course, if the iron ore is available, then we get 30% of that. So subject to, of course, our willingness to invest up to that level. So it's a sweetheart deal. We don't have any downside and all the possible upsides. So similarly, since we are doing the lithium exploration in the same tenement, so the terms and conditions of the lithium exploration is also very, very similar. And both of these are sweetheart deals. And in the lithium exploration, we have another clause that we have 75% offtake rights. So that's adding sugar to the sweetener. So that's a real sweetheart deal. So nothing could be better so far as Legacy is concerned from that deal. Yes, even if the iron ore PFS comes out to be successful, operationalizing that mine should take at least 5 years, 4 to 5 years. That's how the Australian mines, all the approvals, construction. So we are looking at 5 million, around 5 years for that. And of course, if lithium is found, the PFS itself is going to take around 18 months. And if the PFS is good, then we'll take another 3 years to sort of come to a mining stage. But it all depends upon what the PFS results are.
Okay, great, sir. Thanks for the very explanatory answer. So, and on the gold mines, sir, there also we have the 60% economic interest.
No, gold mines are 100% owned by us.
Okay.
All those tenements are 100% owned by us, except this big tenement which we call Mount Bevan.
Yeah.
It was we had 60% ownership, and with the other company, Hawthorne had 40% ownership. And we could not invest in that because Hawthorne would have got a free ride. So there was no dilution clause in that agreement, which was entered 10 years back. So I could not invest, and if I had invested unilaterally, and Hawthorne would not have, they would have got a free ride. So now that the investment is being done by a third party, which is very, very reputed, it has a huge 55 million ton, 60 million ton mines in Australia. So they're the real big brother to be with in the Australian mining area. It's a sweetheart deal that we got.
And sir, 5 odd years away from now, so it
yes, the initial PFS results, technical results are all fine in the iron ore. They're all very, very encouraging, the initial PFS results. But we'll have to wait for the entire thing about water and about logistics and all those things are being worked out with. So we're keeping our fingers crossed, but we are optimistic. We can't have any definitive sort of a say right now.
And lastly, on this lithium reserves in India, anything you are hearing from the government?
No, we have not been offered. Obviously, we are not going to bid. I don't think that's going to be, because we don't have adequate data and we don't plan to bid on a deep-seated material. If it is offered to us on a reservation, we'll take a look at that at that point of time.
Great, sir. Thanks a lot.
Thank you. We'll take the next question from the line of Satinder Singh Bedi from Eon Investments. Please go ahead.
Yeah, congratulations on great production and
Sorry
sales.
to interrupt. Sir, your audio is feeble. May we request you to use your handset?
Yeah, can you please increase your audio?
Yes. Congratulations on great production and sales numbers for the quarter. Sir, you've given a long-term forecast of 100 million ton over the next 5-7 years. What are the indicative kind of figures for FY24, 25, 26? Because we'll have a greater handle on that, I guess, at this point in time.
We have an EC of 54. That is, this year we will say anything between 47, 49, and if we can prepone our things that we said, so it could as well reach 50. But that's something more aspirational than doable. 47 to 49 should be for this year. Next year, of course, definitely will cross 50. So, because by that time we would have operationalized all 4 of these things. So we'll definitely go about 50. We'll try and touch our EC capacity of 54. So that would be our plan. So we are working on that.
Okay, and the current projects that are under execution at this point in time, what do they take our capacity to? The pellet, the slurry pipeline, beneficiation plant, screening plant, and so on and so forth. Okay, so and this.
You have to look at the project in 2 different. One is the dispatch and marketing and sales related projects, which are the slurry pipeline and all the things, and one is the production related project, which is the screening plants, etc., etc. So the screening plant in Kirandul, for example, is 12 million ton. The one that we have tendered out last week at Karnataka is 7 million ton upgradable to 10. We've just tendered it out last week, right? And the downhill conveyor that we are tendering in the next week would be the downhill conveyor and the crushing system at Kirandul, 14C, etc., is another 10 million ton. So these are the ballpark things. So from the production side, again, we need to get these done. The other mines also need to upgrade, and we need to make this investment in the next 2-3 years so that we reach at least 60 million ton from Baradena itself. The current is around 30 million ton. So we'll try to reach around 50 plus. And by that time, NMDC, CMDC should also come. That's deposit 4 and deposit 13. Deposit 4 would be operational next year. Deposit 13 might take a little bit longer. So we should have another 7 to 8 million ton from NMDC, CMDC Limited. So that's the broad outlook. Now you come to the dispatch side. Of course, as you know, that we are upgrading the railway line from 28 million ton capacity to 40 million ton capacity. And what the railways are doing, in fact, it will be effectively 55-60 million ton capacity evacuation through rail itself. Okay. And I'm told that the number of wagons that the railways have ordered, the availability of wagon in the Q4 and going forward in the other financial years should not be a problem. So we have a fair bit of evacuation capacity out there, and around 15 million ton of slurry pipeline we are already building. So that's our evacuation plans from there. We'll have to take a serious look at the Karnataka dispatch also once the upgradation plans are through. So we need to take a call on that.
Excellent. And so we recently saw an EOI inviting expressions of interest for exports. Okay, so any update on that? On exports, sir, export of iron ore. Okay, so any progress on your export of iron ore plan?
No, not as of now. We have asked for. We are exploring that market. As of now, at this current prices, our domestic net on a net back method, our domestic realization is more than our export realization because of, as you know, the 30% export duty that is there. But yes, going forward, and there is more than adequate domestic demand for our products. But we must keep that export window open, because if tomorrow there's a slight slack in demand or the prices go down and people start importing, then we need to sort of just to keep ourselves afloat when you are ramping up to 50 and from 50 to 80, 70, 70 to 90 and to 100. So unless you keep that window open, it would be a major challenge. So we've decided that we should be off the blocks as soon as possible. Have some tie-up, do some, keep the window and the market open so that people internationally get confidence. But that's more of a sort of a long-term plan for which certain short-term things need to be done. So that's what we're doing.
Right, sir. So finally, sir, since the single largest cost head is actually the royalty and the additional royalty and the various fee and cesses, so this application of the same would help. So earlier we used to pay an additional royalty of 22.5% out of our basic price. Now there's no basic price per se. Now we have a list price which includes the royalty of 15%, the DM fee, and the NMDC fee. So how does it change? So how's now the?
No, it doesn't change. Don't worry. It doesn't change. You've seen the math. Even if you see the IBM prices,
right, sir,
they were declared including all, right?
Okay.
We have just aligned our prices to the IBM prices. So when our basic prices were, let us say, 4,000 rupees, the IBM prices were 6,000 rupees. Including all those, not 6,000 rupees, it was around 5,000 rupees. Okay, including all those levies. So IBM used to declare 5,000 when we had a basic price of 4,000. We have now just aligned our prices with the IBM method of calculation, which was being done by all the merchant miners except us. OMC was doing it, all the private parties were doing it, except we are not doing it. So we just aligned the method, but our liability for 22.4% will remain on the net back method. So they'll deduct the royalties. You cannot have 22.5% on royalty again.
Yeah,
right?
Yeah, that's right.
So it will be taxation on taxation. So that can't be done. So that liability towards additional royalty of 22.5% will remain on the net back method. So there's not going to be any change in that outgo or something.
Understood, sir. So sir, to help us model the potential revenue. So if 100 were our list price now, as per our new pricing mechanism, then what will be the royalty component out of that? So if 100 is our list price now, what will be the royalty?
100 is equal to, let us say, 121.4.
Yeah, and our realization will be 77.5.
121. You divide 100 by 121 by 4, and then multiply that. But there is other correlation factor that we had factored in for the July pricing, just to insulate us from the vagaries of IBM pricing. So it will not be a straight calculation. Yes, out of 100, I think it should come around 78%, 78.9% or something like that.
So what we are saying is that effectively our sale price, if sale price is 121.5, excluding the forest permit fee, transit fee, and the environmental cess, then our net realization will be 78 or thereabouts, out of 120.21.5 or 121.4. Is that a fair?
Out of 121.2, it will be 100.
No, sir, because
out of 100, it will be around. If you take that as 100, then this will be around that figure. But I need to do some calculation on that.
No, sir, the additional royalty will have to be still paid because 121.
The additional royalty is a part of my cost. It's not a It's not a pass-through item. It is not a pass-through item.
Yeah, but net of our royalties in our line item, okay. So the net of royalties, we will realize a net 77.5, 78.
Yeah, around that part.
Okay. Thank you, sir.
So if I take out that also, then
I'll come back in the queue.
Thank you. We'll take the next question from the line of Mohammed Farooq from Pearl Investments. Please go ahead.
Good morning.
Good morning.
Can you hear me?
Yes, sir.
Yeah.
Please proceed.
Yeah. Okay. Fine. Thank you. Thank you for the opportunity. And over the past 3 years, I have been consistently participating in NMDC conference calls, where we have been presented with range of positive news, including achievements like record production level, ambitious target of 50 million tons this year, and next in 5 years, 100 million tons, substantial investment in capex plan, and venturing into gold mine, lithium production, substantial cash reserves, new logos and solar power generation, so many things. Despite all the positive factors, there appears to be a lack of investor confidence in the management. The market often seems unresponsive to the positive news. For instance, during the export ban, investors lost 50%. But when the export ban was lifted, we saw only a 5% jump. Could you please shed light on how NMDC management is addressing these perceived low investor confidence?
We, of course, put all our achievements and all our aspirations in the public domain very regularly. I interact. So I don't think it is investor confidence, or rather, as you say, lack of investor confidence is due to lack of communication from the corporate. I think we are a very transparent company. Our numbers are there, and the information of our future plans, etc., is there. Obviously, yes. But I think that most of the PSU stocks are taken as a dividend yield stock rather than a capital appreciation stock. So when my personal perception is that when you have a portfolio of around 40-50 stocks, you will sort of categorize them into some of them which give you a standard dividend yield, some of them which where you expect a capital appreciation, and fortunately or unfortunately we fall under the sort of a dividend yield category of investment. So naturally, people, I think that's my perception, because we are government owned and some amount of our dividend yield is one of the highest in the country and in the world around 11%. So I think the investors are more sort of akin, looking at us as more of a steady income rather than capital appreciation stock. Of course, whatever I see from the different analysts, like a lot of people who are attending today's call, they've all been very kind to sort of always keep us in the buy category rather than the hold or sell category. As a company, even if you see our performance parameters internationally, if you compare us with Vale and Rio Tinto and BHP and FMG, and we have the lowest C1 cost. Our risk rating are much lower than Vale or many of the international or Indian companies, including Vedanta, and we have a much lower risk rating. Our parameters, other things like GHG, or you take any parameters as a company, we are very.
Your cash reserves is 33% of your market cap currently, 11,000 crores. Yeah. Still,
a lot of it goes to dividend, around 3,000 crores goes to dividend, but yes, now we are ramping up capex. Another 2 years, we would be substantially investing in capex, because other than that, without investment in capex, substantial quantum jump in capex, you cannot hope to reach 100 million ton. So some of them are already progressing, some of them are active.
Fine. My next question is, in the previous conference, I highlighted about the NMDC's top clients like RINL, JSW, ArcelorMittal, and KIOCL. Given that any reduction in purchase by one of these clients could substantially impact NMDC operation. The recent instance with JSW, purchases being 50% below expectation in July, has severely impacted on production and sales of NMDC. It was unexpected for NMDC to witness 50% drop in purchases of JSW within a month. Now the good news is you have export EOI. Okay, with the global export market accounting for more than 1 billion tons, I'm curious to know if NMDC has a specific target, monthly target, perhaps a range of 1 million tons, or whether the company is more reliant on buyers' demand to determine the export target.
Oh, that's a good question. Let me take the part one of your statement first. Yes. You know that 70% of our sales go to three major buyers, which is a business risk, right?
Yeah.
By any standards, we are aware of that, and accordingly, our plans is to diversify our customer base. So the first step has already been taken. We have an intermediate stockyard at Kumar Maranga. And going forward, we need many more such intermediate stockyards, and from where we can dispatch to, from where we can cater to markets like Raigad, like Western Odisha, and other places. So we need to 40 million ton production and sale and 100 million ton production and sale are two different ball games altogether. They are completely in terms of your marketing philosophy and everything. It's a major paradigm shift. So we are aware that we need to increase our customer base, and accordingly we are making out plans to sort of increase our customer base. And one of that is having intermediate stock and blending yards. So, but they'll take 3 to 4 years to come, of course. Yes, the buyers, when the mega buyers that we have, 3 of them account for 70% of our sales. So naturally, there is dependence on them right now, which we need to get out of. Regarding export, yes, as you know, that as of now, the numbers don't make sense, because your net back in realization in domestic is greater than the net back in realization in exports, because you know in exports you have to pay 30% duty, you have to pay the freight, and you have to pay the royalty, DMF, all are on your account, right? So if you calculate the net back economically, it doesn't make sense to export today. But as I was saying to the previous caller's question, that we need to keep that window open for the volume's sake. So even if I were to do around a 10% less realization in export, I should have that window open to give me the volumes that I need to do. So as a result, having a monthly target today would not make business sense. But going forward, when we really ramp up our production and we are through to the distribution sector, yes, then as a business sense, selling for a net lower net realization doesn't make too much of a business sense. But we need to keep that window open for strategic reasons. And as a result, having a 1 million ton or 500,000 ton export target for a month-to-month basis, as of now, wouldn't make great business sense. But yes, going forward, it does when we ramp up enough production. Also to sustain the domestic prices there.
Okay. Could you please update on the the latest in export EOI that was done like a month back?
Yeah, export EOI is done a month back. I really have not seen followed it up too much, because that's more of an exploratory nature. So I'll have to get back to you on that one.
Okay. So what's the projected Q2 target for production and sales? Final question.
Q2, I think last year Q2 last year. Just a minute. Last year Q2. Just give me a minute. Let me get to the numbers. Last year Q2. This year the dispatches will be very substantial, because we had a lot of stock and we've been able to service our customers very well. So July we have done more than that. So Q2 last year, I think we did around 7 million tons in production. I think this year we have already done by July, I think 2 point something. So I think we should be doing around 8 million ton in Q2. I think last year instead of 7, I think we should be able to do 8. And in terms of dispatch, last year Q2 was around 8.5 million ton. I think we should be slightly increasing that to around, we should be marginally above that as well.
Thank you for your reply, sir. So the participant has left the queue. Ladies and gentlemen, due to time constraint, that was the last question. I would now like to hand the conference over to Mr. Amit Dixit for closing comments. Over to you, Mr. Dixit.
Yeah, hi. Thanks, Amitabh sir, for very patiently answering all the questions.
On behalf of ICICI Securities, I would like to thank all the participants for attending the call. I would like to turn it over to Amitabh sir for the final comments. Over to you.
Thank you, Amit. It's been a nice quarter for us, but going forward, I think we'll have to build up on this momentum, and if this momentum goes, and we are not only looking at the next few quarters, but we are looking at the next few years where a quantum leap needs to be taken, and we are preparing ourselves for that, both in terms of investment physically and as well as in terms of corporate culture and all infrastructure. So we hope to see NMDC 2.0 in a completely more efficient, agile, and a much bigger scale than we are at present. We are capable of doing that, and I think we owe it to the nation and the investors and the industry to realize our potential. And I think we'll going forward, you see a completely different NMDC. We are proud of our past achievements, but then we intend to do in the next 5 years what we have done in the last 60. So that's the challenge, to squeeze in 60 years of achievement and experience into next 5 years of performance. So that is what we are preparing for. Thank you so much.
Thank you, members of the management. Ladies and gentlemen, on behalf of ICICI Securities, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.